Hi guys, Brown Asset Management here, and today we're looking at the Procter and Gamble company ticker symbol PG using my 7 simple steps. Just before we get into it, I just want to say please give a like on the video. It really helps me out and I can help you guys out by bringing more stocks. So now let's have a look at the share price. You can see that before the pandemic it was around about $126 a share and then hit a low at around $97 a share and has gone a very strong rebound and eventually hit its all-time high at around about $146 a share and then has dropped a bit slightly but is now around 130 on a bit of a rebound. So Procter and Gamble has a market cap of $333 billion and currently has a share price of just under $135 a share. It's in the consumer defensive sector, and let's have a look at my 7 steps. First is the P/E ratio less than the market, and Procter and Gamble has a great P/E ratio of 25.5 and the market is currently at 40, so that is a pass. The second step is the P/E ratio less than the sector, and the sector, as said before, is consumer defensive, and that has a P/E ratio of 27.3, and with 25.5, that is another pass. Looking at the bonus step, does it have a P/E ratio lower than the historical average? And the historical average is 17.5, and it does not, so I'm not going to give it an extra check mark there. Third step is the revenue increasing, and the revenue has gone from just over 65 billion to just under 74 billion. So that is a very good increase over these last 4 years. So that's a pass there. Step 4 is the profit increasing, and the profit has actually gone from 15 billion to 13.5 billion. So that is a fail. Now we want to see if PG are buying back their shares to reward investors, and it has gone from 2.553 billion to 2.479 billion. So that's a pass. They're excellent. They're buying back their shares. Step number 6, are the current assets greater than the current liabilities? And the answer is no, with 28 billion to 33 billion. So that is a fail. They can almost pay off all their current debt with their current assets, but it isn't a pass. And obviously therefore their total liabilities is not a fail with 40 billion. And finally is the free cash flow increasing, and the free cash flow has gone from under 10 billion to 16 billion. So that is a pass there. So that is 5 passes, 2 failures, no bonus marks. The failures with the profit and the current liabilities not being greater than the current assets, but good free cash flow, good P ratios, and increasing revenue and buying back their shares. So now looking at my free cash flow yield and ratios, these are my favorite metrics, and to get these I divide the free cash flow by the enterprise value, and the enterprise value is market cap plus cash and cash equivalents minus total debt. So PG has an enterprise value of just over 340 billion, and with a 16 billion free cash flow, that gives a free cash flow yield of 4.75%, which is a free cash flow ratio of just over 21. So they are very good numbers. I'm looking from 3 to 5%, 15 to 30, and this is well within these margins. So in terms of free cash flow yield and ratio, it's looking very good for PG. Now, one thing I know that a lot of you guys are going to be interested in is PG's dividend. It has a massive $3.16 dividend, which is a 2.34% dividend yield, which is very good. It has a dividend 3-year growth of just under 14%, which is excellent as well. And if we look at these payout ratios, it is a very safe dividend. 62% of the trailing earnings, which is borderline high but fine, and then 56% of this year's estimates, 52% of next year's, and based on the free cash flow, which is what they use to pay dividends, is 48%. So it is a safe dividend. This isn't going anywhere, and if anything, it is increasing. They have 59 years of consecutive growth, making it a dividend king. You can see that it's a quarterly dividend and was increased this year in April, so expect it went from 75 to 79. I would expect a similar increase on the next dividend. And if you want this massive dividend, then you have to purchase your shares before the 22nd of April, as that is the ex-dividend date. So buy your shares of PG before then if you want a dividend. Now let's have a look at some analyst ratings, and analysts actually have it as a moderate buy with 4 buying and 5 holding, with a target price in the next 12 months of $150 a share, which is over an 11% upside. Now, if we look at the analyst forecast, they have it high as $169 a share and even as low as $130. So worst case scenario, analysts are saying the price will pretty much hold, and on the high side, you can get a $30 increase on your shares right now. So they are very good estimates from the analysts. So now we're going to look at my valuation of PG using my discounted free cash flow model and then the Buffett-Graham intrinsic value. I've calculated the future free cash flows up to 2024. I've even given this number as a bit of an outlier and sort of continued the previous numbers between 2018 and 2019. So my discounted free cash flow analyst is a little bit on the conservative side. But as you can see, I've gave it a calculated stock price of $176 a share, which is currently at a 30% discount. So discounted free cash flow definitely says it's a buy. Now on the Buffett-Graham intrinsic value, which uses earnings per share and growth rate as its estimates, and that gives it as a fair value at $153 a share, which means it is trading at a 13% discount, but gives it at a Graham price at $115 a share. Now, I wouldn't be too worried about that because this would mean that if you want to buy the stock at this price and hold it for 20 years, then this is the price he would recommend. Although it does currently state that it is undervalued as part of the fair value. So both models looking very bullish on PG. So now we're going to look at some of the technicals. I have the price with the candlesticks, a 50-day moving average in blue and a 200-day in yellow. Now if we look at the bullish signals, you can see that in June and July the price crossed over both moving averages, which would have been a strong buy signal. So you would have bought here at 120 and then you would have held up at least till 140, 130, so that would have been good money. There was another bullish signal here with a golden cross, but in the more recent times you can see a bit of a different story. You can see that the price did drop below the averages, drop below both of the moving averages actually, and then a death cross here where the shorter day moving average crossed over the longer day. But again, then the price has crossed through both averages again, so very turbulent over the last few months. Very hard to trade based on the technicals, but as you can see, it's had a lot of buy signals here and then some bearish signals here and then bullish again, so a lot going on. So I've just set up a parallel channel here and you can see it has identified some of the high points and the low points over the last 2 years. You can see that when it's hit about this level here, it has dropped down, and then once it's gained this level, it has rallied back again, hit this channel again in October, dropped down in March, and is then rebounding again. So if this is anything to go by, you can see that it could reach up to about $152 before dropping down again. So this would be a buy signal here. Let me know if you want to include this more. I'm trying out new technical analysis to try and bring as much value to you guys as possible. Just want to say thanks for watching the video. Please leave a like if you've enjoyed it and consider subscribing if you enjoy these stock analysis videos, and I'll catch you guys next time.